Hey, mate. Well, it looks like we're on live, Andy. Good to see you again, mate. A little bit later today for our Facebook Live, the Wine and Wisdom session, but it's been a pretty long day, but a good one too.
It's been pretty incredible. I reckon we've probably been a part of one of the very first type of virtual events, possibly even run in Australia, which has been really interesting, seeing how a business can pivot so quickly and turn what was meant to be a business leaders retreat on site and on location, and now we've got all of these funky little kits and little games and prezzies and things from our mate Kerwin Ray, which has been pretty nice, including a little cocktail kit for the cocktail function. So
nice.
I reckon later on we might do some sessions in and around sharing the experience of this, because it's actually been an incredible day, and almost like we've been at the event.
Yeah. Well, for all of those who are tuning in for the first time, or some of those who sort of tuned in for the second, third, or fourth time, so Andy Fenton, Jason Witten, Positive Real Estate, Fenton Financial, we're sort of doing our end of weekly wrap, and like last time Andy said, this is kind of like our debrief of the week. You know, we've been in the world of finance and financial industries, from the real estate world and from the equities and planning world for over 20 years. And today, as we have been doing for many Fridays now, we get together and have a little bit of wine and maybe see if we can unpack a little bit of wisdom for ourselves and maybe those who are listening in. So listen, if anyone's got any questions, chuck them in the chat. We're getting used to the questions and answering the chat stuff too. So, and we've got a bit of a guest here who was a guest last week, Paul Sidorovsky. He's going to pop in for a bit of a 5-minute update on all things JobKeeper and stuff that's obviously going on. But Andy, mate, what's the news out there in the world of business, finance, and what's hot off the press, mate?
Mate, it's been interesting. Just while I do, I've seen Paul just jump on as well. So if you want to link him into the convo,
yeah,
mate, it's been interesting. We've seen a lot of earnings reports starting to come through from banks and various different suppliers around the world. G'day, Paul.
How are you guys?
We're very well. Very well.
That's fantastic.
Mate, thanks for coming over a drink with us again on Friday.
Mate, we're going to turn into alcoholics, mate. But lucky I don't drink alcohol, so that's even better.
Well, they said by the end of this virus that there's going to be two new skill sets. You're either going to be a very, very good cook or a very, very good drinker.
Mate, I love it. So I've failed at both. That's okay.
Well, rather than me rambling on, I know you've got other commitments, mate. So I appreciate you coming on, or both of us do. That we've had more and more questions in and around JobKeeper. The longer this is around, the more questions get asked. So, mate, can you just give us the 5-minute update on the JobKeeper and the main questions that you've been seeing? And I've got absolutely a few extras. If you don't answer them, I'll just ask them when you've finished giving the update.
Yeah. So the biggest one is the assessment period, like the eligibility of it. So you can actually qualify in the month of March. So if your March revenue was 30% down to the March in 19, just for the 1 month, you're in the system. You can also qualify for the month of April by itself. No matter what reporting period of BAS you are, you can qualify for the month of April. And they're both on fact. So, March is finished, April's finished, you can qualify on fact. And again, based on the period last year. Now, if you don't qualify for those two and you're a quarterly lodger, you can still qualify and start from the beginning. Remember, like from the month of April, the whole month, to get the JobKeeper for the full month, you can still qualify by making a projection for the quarter of June. So if you project that your revenue is going to be 30%, you've got a basis for it, you can actually qualify, okay? And that's it. You're in the system. You can get people that they will audit you. If you lodge your BAS and you're way out, then you may get audited. Now, let's say you can't qualify for the quarter, can't qualify for March or May or April individual, but you can qualify for the month of May, then you qualify for the month of May. You can project for the month of May or wait till the end of May and register at the end, so you're in, and then it starts from May onwards. You miss out on April. So that's been a big one, that qualification period. Now, the second biggest question is this cash versus accrual. If you're on a cash basis for your GST reporting, you can choose to either report on cash or accruals. So that's a big one. If you're on cash and reporting on cash, you can pick cash or accruals if that reflects the period, and that helps you in assessing the 30% reduction. Now, if you're on accruals basis and you want to report on a cash basis, you can, but you're going to have to provide a valid reason of why you're reporting on a cash, and that represents your business better than accruals basis. So Andy, they've been the two biggest questions that we've been getting. The eligible employees, they changed it from, this was massive for restaurants and so forth. 16-year-old kids that were getting $70 a week were now about to get $750. So they changed that as well and said that if you were 17 or under at full-time education and not financially independent, just living at home still, then you're out. So they canned a lot of people that were otherwise going to get $750 that were earning, $50 a week. So yeah, they're the big things that have been, people are asking. Oh, and I've got and the last one. Once you qualify for the month of March, month of April, in May, order for the quarter, you're in the system. Your turnover goes up 5,000% next month. It does not matter. You are in the system. And it qualifies for 6 months. People are already starting to speculate. Government's going to stop it. Oh, they're not.
Yep. And the big question that we're getting, and just confirming it again, because you've said it a few times, is every employee must be back paid to basically have been paid fully right the way through the period.
So another great point. They've extended the registration period to the 8th of May. That means you can also top up the employees by the 8th of May. Now, people may not have the money to top up their wages. Banks are doing short-term bridging loans, 20,000, 30,000, to get people topped up and paid, so they can be eligible and get that. So any eligible employee that's, remember, has either been stood down or is working full-time, or working less hours part-time, or a casual that's under that criteria, if you have not paid them $750, even one, you miss out on one, it brings down the whole ship.
Wow. Okay, so literally every single employee must be paid. If you
every eligible employee, yes.
That it brings down everybody. Mate, there are a couple of other questions that just came through on the site, so I'll just run through them. This one's probably a little bit more HR. It basically says, do you have to guarantee an existing role to return to? We just don't know.
Sorry. Do you have to, if you've stood them down? I'd say, okay, so let's say you've stood someone down and they're just getting the $750 payment.
Yep.
They're still employed. Someone who stood down is still employed, accruing leave, accruing everything. They're coming back to their they're coming back to their job. To get rid of them, you're going to have to do the same HR rules that you were before. You've got to apply to all the other rules.
Effectively making them redundant or what have you. Yeah.
Or performance management or whatever. Yeah.
And I think that there's been a few of those as well. Just there's another guy, Tony, who we both know, actually was just asking a question the other day because, well, he's not able to get the performance out of one of his team members at work, who's working from home and is now refusing to come back to work. Are you seeing many businesses kind of struggling with these types of mix of HR/JobKeeper? Yeah,
look, you're going to get, you know what the rules are like, Andy. There's the 80-20 rule. You've got 80% that do the right thing and 20% that feel entitlement or have some other shit going on in their lives, as you know. So, yes, I have seen some of that. Not as much as I've heard on the news and so forth. But you're going to find that. You're going to have people that just go, they're going to be opportunistic, or they're fearful. They're just scared. Like they're really scared of getting it. And look, let me tell you this: they may not do the work, and they may not do what you need them to do. All they're telling you is they're not going to be with you for long term. There's going to be a lot of people, I'll tell you, there's going to be that come to Jesus moment where people are going to have not have a job, and they're going to see, just like the NRL, they're like, think about it, like they're saying, oh, we're not taking a 20% cut until they've got no money. Let's say they don't have a season in place. I bet you they'll take the 80% salary. That's going to be, and look, that's not for debate or someone to, I'm just telling you that it's an example. There's going to be people that are going to, who right now are thinking, oh yeah, I can leverage on this and get some benefit. I mean, what's going to happen after Corona? Like the ScoMo came out today and said they're relaxing. We will be back. Things will all be back open, whether they're 100% open by 1 July. Even gyms will be open and pubs, but it may be at 20, 30%. So you're looking at things are going to be back. And then when the employers are going, who am I going to keep? Oh man, they don't forget. I'll tell you, they don't forget.
Right. Spot on. We've got actually 4 pretty straightforward questions from Trina. Is the JobKeeper payment we receive treated as assessable income?
Yes.
For both the employer and the employee?
No. So the employer, it's assessable to the employer. The $750 payment to the employee is a wage. You got to tax them like normal. And remember what I said last time, if she wasn't on the call, if you've stood someone down and you're paying them $750, there is no super. If they're just stood down and not working, there's no super on the payment. So yeah.
Gotcha. Is GST paid on JobKeeper subsidy?
No.
That is received by the employer?
No.
Are there new payroll items required by ATO? As a brief overview, are there any new payroll requirements from the ATO?
No. So all the softwares like MYB, Xero, it's already been accounted for. So just get onto your software supply. They've dealt with it easily.
And then the last one was JobKeeper payments are fortnightly, but August has 3 fortnight periods. Any advice on how to manage the consideration of aligning the payroll cycles?
Yeah, no, they're pretty good. So remember, they started on the 30th of March. So if you go 7, 14, 21, 28, it finished on the 26th of April. So remember, this finishes on the 27th of September or 26th off the top of my head. I think it's 27th. So it'll finish on that date. So there's no 3 payments or whatever. It'll be aligned where the dates will align so that it won't be more than that $3,000 a month per employee. The $1,500 a fortnight.
And final one from Belinda is how many more months do we have to potentially go negative? So what I'm reading into it is you've talked about this month, next month. What about June, July?
So yeah, good point. Remember what I said, March and April to qualify from day one. So you get it for the full 6 months, you can qualify for March or April, or for the quarter of June, if you're a June quarterly lodger. If you can't do those 3, doesn't mean you don't get it. It just means if you prove it in May or prove it in June or prove it in July or August up to the September, you'll only get it from that month on.
Yeah, okay, yeah. So
you
it's
can
really
still get it.
That you're looking at your forward revenues, very, very important that you're looking at your forward forecasts and making sure that you at least lodge. So even if it looks rosy, just get in and lodge it. And if you end up in that boat, then you've got the capacity.
Oh, absolutely. Look, it's this will be the biggest savior, guys, for small business owners, because let's say things go 1 July, things are at 70 or 80% of capacity. The JobKeeper payment is still there to keep you profitable. Why I believe the government did that was so that in this period where they're not making any money and things are closed or whatever, it'll help them in that period. So it looked great stimulus. They're changing the rules every day. This is ATO legislation. Every day they're updating tweaks to the legislation because, they wrote it and they knew that was going to be, definitions and certain things that need to be qualified and whatever. So they're doing it now, but they're doing a great job, truly.
Beauty. Well, mate, that's been a great update. Appreciate it. Unless there's anything else there, I will give you a little bit of a plug because it's been nice. You've been a good supporter of ours on here and also a number of our clients. So Paul Sidorovsky from Sidcore Accountants that deals with small to medium businesses around Australia. And one of the specialties that he does really well is actually look back on a couple of years worth of tax returns to see whether there's extra tax that you've paid that perhaps you shouldn't have. So if any of you believe that you're in that sort of a position, you know, even if you're not, Paul's been great at just chatting some of our clients through it. And thank you, mate. Appreciate that. But if anybody thinks or is worried about their previous tax position, just give Paul a shout and just mention Wine and Wisdom, and he'll take care of you. Please,
anyone that's on the chat, drop them an email to you guys. Email me an intro, and I'll reach out to them, guys. There's no obligation. I'm just here to help. You know, a lot of accountants, I tell you guys that I'm finding is I feel for them, because accountant businesses don't have that capacity to even service their clients and get through the work they had before, let alone find this legislation, get up to speed with it, and then tell their clients what they got to do. And remember, the job keeper, it's a month. It's like lodging a monthly BAS. You're gonna have to lodge something every month.
Yep.
So we're doing it for our clients. We're engaging them and putting them on for 6 months, and we do their eligibility. We do it each month. So just don't stuff it up. It's worth a lot of money. Someone with a business with 20 employees, think about it, or 10 employees, it's $7,500 a week for 26 weeks. So it's a lot of money.
Yeah, 100%. Mate, true words. True words.
Thank you, boys. Have a good one. If you need anything, anytime, I'm here to help you.
Thanks, brother.
Thank you, mate.
No worries. See you, boys. Bye-bye.
That was good. Great update. Mate, I'd just like to point out that I'm glad you got the memo for the uniform today as well.
Mate, I must admit, because now, you know, working from home just constantly, I've resorted to going and buying some Bond shirts so I don't rip through any of the nice black shirts.
Mate, no, it's good. I'm with you. Hey, listen, I've got a question over in my neck of the woods, and the question is, if I'm receiving JobKeeper, this is kind of, you know, from a lending point of view, do I still qualify for loans and servicing? So the answer is yes, you do, because you're continuing to receive a pay slip, et cetera, et cetera. So that's an interesting one. Right now, we're in the middle at Positive of testing that with a number of clients. So they've been stood down, but the employer is committed to having the business going forward and continuing. They've qualified for JobKeeper and so on. So very, very interesting question. I think you certainly need to check in with each lender. And some of the lenders, some of the financiers have little sort of tweaks and ways they might check in. So, you know, it's not 100% lock, stock and two smoking barrels, but certainly some of the lenders that we've been using at Positive and helping the clients with are perfectly happy as long as the pay slip is still valid and you're being paid the same or more in your pay packet, you still qualify for the lending. So that's been something that we've tested as well, Andy, which has been a good one.
Mate, that's great. That's great. Well, I guess the thing to take away from that is it's still assessable income.
It is, yeah. You're paying tax on it. It's ridgy-dig income. Some of the banks are being a little bit tighter on sort of their future pacing, and some of the banks at the moment are literally, like, for the first time in like forever, are actually calling like 4 times before settlement, and on the day of settlement, they don't let the loan go through until the employer says, yep, they still work here. So there's some scrutiny around that. I don't think that's going to go away in the future of lending. If you're going to be buying a property or lending any money of any description and you're relying on your personal income to qualify for those loans, that's going to be there. The lenders are going to scrutinize it more and more. You know, like what Paul said, you know, make sure you get everything in order and get it right. Like if you're an employer, you got to get it right for qualifying for JobKeeper. If you're an employee and you're applying for a loan, you got to get it right because the lenders are going to scrutinize this thing like there's no tomorrow with a microscope. The money's cheap. It's actually amazing interest rates and all those things, but they're not going to let it fly like through. And then you could go, oh, hey, listen, I'm looking for a holiday. You know, they're not going to do that. So yeah, make sure you sort yourself out first. Make sure everything's ridgy-dig. Talk to a great qualified mortgage broker or I prefer a coach. That is because the mortgage brokers are legally committed to disclose certain things to the lenders. And if you're organised in a certain way, you tell the mortgage brokers what they need, and then that's the best way to go about it. So good question.
An ex lending professional that I used to work with, I think worded it really well. He said that the broker's job is to paint a picture, is to paint the right story so that the bank can accept what's being proposed. Now, that's not to say that you lie or cheat, but it's actually the way that it's framed and packaged up, and that can make a big difference.
One of my coaches put out a little video today about you don't overshare with your professionals, right? So, you don't overshare.
It's a fine line, right?
It's a complete fine line, and to be honest, you then give them so much more responsibility, and it's actually not fair. That's the way we see it, So you give the professional exactly what they ask you for, and nothing more. That's the way we approach it.
It's the same with insurance, because then if you do over disclose, then you can't take back what's said, and then they will investigate. So statutorily or contractually, there is a certain amount of information you're obliged to put forward, and you don't want to disclose anything more, because then it can really hurt you moving forward. So having that good guidance, both insurance and mortgages, is crucial. And making sure that right now as well, understanding the probability of your loan actually being accepted is pretty important as well, because you don't want to be getting some other black marks on your record. And if bankers just lodge applications, and this is where you've got to be careful about going direct to banks, because if they go, yeah, no worries, we'll get it through, and then they just flick it through and it gets knocked back, well, that's a bit of a black mark against your name.
100%.
So having that broker there is sort of crucial. But I had a few experiences this week with the bank, and I guess the feedback that I'm going to put out there right now, and this is from personal experience, and I think there was something on the news as well. If you are in a good position or a reasonable position as a business owner, or as a normal property investor, or just as you're a salaried employee who has still got a good income, and not the sharpest rates on your personal home or investment loans, reach out right now and chat with your brokers.
100%.
Get on board, because they're okay now. And so think about it this way: the bankers are living a little bit in the policy world of pre-corona, and have got some flexibility now in the world of corona. But what I believe is going to happen is, once corona sort of gets established and is gone, and then there's a new landscape, then the bankers are going to start to get that magnifying glass, and it's going to turn into a microscope. And it may then be very, very difficult. So it may not, right? But the odds are, I think, in my favor. I think that, I'm looking over the horizon, and it's going to be pretty accurate. So getting in,
they're going to scrutinize, mate, for sure. 100%. We're already seeing that in the lending space in the teams that we use, and you'd be seeing it as well. They're going to ask more questions.
But the problem is, you have to leave, and this is the part that I was pretty disgusted with. I won't mention the bank because I don't want to get sued, but effectively the conversation went like this. Yes, we have to break the loans. I know that I can get 2.5 elsewhere, and we're way out of whack. And I also know through my clients I can get 2.5 with you. Right, which is the kicker. I don't know where you're getting those rates. Well, the answer was from you, right? From you, mate. And look, I know how to press, and I know how to pressure institutions, and I know how to paint the right picture, mate. I got a deal, but nowhere near what we were looking. And so we're going to have to move. Like, it's inconvenient, but if I'm going to move, I need to move now while we've got good financial, because who knows what's going to happen in 6, 12, 24 months.
100%. This is the conversation I have, in the world, and it's not necessarily the right way to use these words. Like, certainly when we talk about liquidity in your world, we're talking about press a button and get your money, or close enough to it. But the world of liquidity in real estate, people talk about selling. Well, that's a dumb idea. Liquidity in real estate through sales is stupid. The reason I like real estate is because real estate isn't liquid. It protects you from stupidness, because people make decisions based in fear and stupidness. And I like real estate that you can't sell it fast. Like, that's one of the things that I like about it. because, you know, one day you get scared and you fucking press your button and your ComSec account and you've got all your money back. You know,
Yes.
That's the benefit or whatever. So, but at the end of the day, liquidity in real estate is there's a way to be liquid, and that's with lending. You know, if you have your lending solid, e.g. where you're going with these conversations, if your loans are, you know, created in a way that where you can top up and have access to equity and so on, that liquidity is vital. And again, you know, this is one of the reasons for me, and depending on strategy, you know, I talk to clients all the time and they're like, I want to pay my home off. Do I do principal interest? And I say, well, depends on your strategy. And if your strategy is acquisition, then principal interest is dumb, because you're giving the bank all your money and they have the power to only pay them the interest. You can pay more if you want to, but put it in your offset account, because that gives you the power of the money that you're putting there, rather than like potentially what you're trying to do, call up and negotiate with the bank because they have the power. You have to leave, and it's really annoying. So, you know, understanding those little nuances in this world, super important, you know, in that sort of space for sure.
Yeah, and the problem is, if you don't act now, I don't believe that you're going to be able to get it in 6 months' time. Now, that's my belief.
Yeah, well, I tend to agree with you on that one, Andy, because right now it'll be easier for the moment, and in the future, if things change for you and also their scrutiny, it's going to be more difficult. There's so much. Yeah, it's the opportunity to renegotiate and reset things at the moment. Just go for it. Like that's what we're telling all our clients. Rip in right now, and just be the squeaky wheel and go for it, and change if you need to. You know, I got a client the other day. I'm not promoting this bank because this bank has been the worst bank. I'm not going to tell you which bank it is, but they've been the worst fucking bank for 20 years. I've hated them. And then the other day we did a deal with them because they were paying $4,000 for our client to move from one lender to another, and their interest rate went from 4.2 to 2.28 fixed for 3 years. Interest only, 90% investment. It was fucking.
Does it look like that? Is that the one?
Maybe, Andy. Maybe I'll tell you off air. They've been a bunch of pricks for 20 years, and now they're doing fucking cracking deals. But anyway,
and that's it. Some of them are paying to move, and it's. But that's the funny thing, is that they won't pay to keep you.
Yeah,
that's
weird. It's weird. They'll give a new client the loan, but they won't give an existing client the same deal. I think it's fucking stupid. But anyway,
totally. And with those things, even if you've got fixed loans, right, which you're going to have break fees associated with it. Let's say you've got a $10,000 break fee on a 4% fixed loan or something. That $10,000, if you then refinance potentially to this bank, or there's other banks that are giving $5,000, then that's half of the break fee. And then you just do the calculation on the additional savings on it. And quite possibly by the end of 1 year, you'll be net positive position. So really crucial to look at it. Just mate, a bit of a funny thing that's just happened as I'm watching the screen here. We got our first, angry face on the Fenton Financial page. And I've just popped it up to see who it is, and it's my mum.
Is it because I swore? Sorry, Andy's mum.
I was just thinking, who would be nasty enough to actually put an angry face while we're here just having a bit of a chat? Unbelievable.
Sorry, Mrs. Fenton.
So, just I guess a good segue into chatting about markets a little bit now, because we've seen some good movement in markets. And one of the best comments was by Malcolm Palmer, who we've been sharing some investment updates with, and manages a lot of our Australian equities portfolios, was, this thing is a long way to play out economically. And I think we all know that, even once we're back in whatever the new world is going to be, there are going to be fairly severe bouts of volatility. So if you've missed the first bounce, then there's probably going to be, if you missed, getting in on your Amazon, or missed getting in on your Macquarie Bank or whatever it is, there's likely going to be bouts of volatility over the next 3, 6, 12 months. Yeah. So it's one of those periods of time where if you do want to, and you do have the risk appetite to invest, there will be those opportunities that will come, and being patient and a bit pragmatic about how you deploy your cash reserves is going to be, really important. Or if you want to shift into a more aggressive portfolio. The one thing that we are seeing, and whether it's priced into markets or not, we don't know, but we've certainly seen companies like, I think it was Sonic came out and they cut their dividend for the half to zero, which means that as a share, they're not going to distribute to their investors any income for the half.
Well,
now, they don't need to.
Some of the banks did 80%, right?
They haven't all come out yet. There's only been 2 of them that have come out. Macquarie's due on the 8th, so in 7 days.
Yeah.
What I think we're going to see from the banks, and we've already, who was it? Was it NAB? I'll come back to you on that. Or if you're curious about which ones it is, let me know. But they've already come out and they're starting to do share raisings as well. So there's some really good little opportunities to potentially pick up some good discounts, because what they're doing is they're cutting their dividend because effectively the government's giving them money.
Yeah, they're going to cash up. They're going to collect the cash, right? And then they're going to go on a fine spree, right? Yeah.
But also they can't really give it to investors. Like, it's not the right message to send. The government gives us money to stabilize the economy, and we're just going to give it straight back to investors as a dividend. It's not cool. Dividends are meant to be a sign of profit of a company. Yeah. And like it or not, we need our banks to be, profitable. Otherwise, we don't have a banking system. They just probably don't need to be as big a bastards as what they are at the moment. But we need them. But what you're going to see is you're going to see a number of them probably cut their dividends or completely wipe them out. Now, that's going to have an effect on market. You're also going to potentially be able to, because as they come out and they do their financial reporting for the year, they're then going to talk about the actions that they're going to do to prop themselves up. And what we're seeing is a lot of companies go to capital raises by doing what's called rights issues, or issuing more shares to the current shareholders at a discount to whatever their current trading price is. So as an example, if Macquarie was at almost $150, it's been trading in around high 90s. Macquarie might come out and say, okay, if you own our shares, but you have to own them, if you own our shares, we want to raise capital, so we'll issue more shares at a lower rate than what the market is. So there's little opportunities like this that if you're aware and if you're keen to be in on it, and Sonic is a classic example. Sonic didn't need to cut its dividend, but the reason why they did is to establish their war chest, because again, they don't know how long it's going, and there's going to be great opportunities from this. So if you can keep that money, it's a good opportunity for the future. So when we're seeing dividends being cut, there's the good, the bad, and the ugly, and you have to kind of ask yourself the question, why are they doing it? Because it's not always a bad thing. It's actually some companies are doing it for really good opportunities. But we're seeing some really interesting movements in the market at the moment, and I suspect that volatility is going to continue to play out. But our sort of position is starting to nibble around the edges of it, because we are going to start to see what life looks like soon.
Yes.
In Australia, but remember that the rest of the world is not in that position.
Still has to play out. Yeah.
Yeah, 100%. So that's going to be really interesting when that comes out.
I think that'll be maybe a good time to put a pin in this, and maybe even sort of leave that one hanging for next Friday. Maybe you and I talk about the opportunities we see in the marketplace. We've been talking about some structural issues, some of the other stuff, but I felt a bit inspired today. We got to hear from Vern Harnish, a guy from Scaling Up, like a crazy cool dude, and he was talking in hundreds of millions, billions of dollars, raising money, going crazy. So I think that'd be kind of cool. Maybe next week we could maybe wax a bit of lyrical, because I've got some, I'm optimistically bullish in the right acquisition pattern for real estate too, because I think the tide's out. The tide's out. Interest rates are so low. Real estate, the piece of real estate has to stand on its own 2 feet, right? Like, interest rates can't go down and it goes up in value because money got cheaper. You know what I mean? So it's interesting. So maybe that'd be a good one for us to sort of cover next week. And if anyone listening in has got any questions for us, maybe next week, it'd be awesome maybe for people to sort of shout those out and, give us a bit of a heads up on that, from in my neck of the woods, in Positive Mentor and Positive Real Estate Crew, and then Fenton Financial and the private group as well. So, mate,
mate,
happy. Got a little virtual dinner to get to.
Mate, I'm just going to go through a couple of questions. I think that's great. So if whoever's listening wants to hear about some opportunities, let us know, because we can talk. We can wax lyrical on it, because there's a lot going on. And my prediction for great investments, and one of the reasons why I like Macquarie, I'm not telling you to buy Macquarie, but one of the reasons why I like Macquarie, and I've never liked Macquarie because I used to work for them, is that I see the future is going to be massive amount of mergers and acquisitions, and can talk to that a lot, because in times of great challenge, great companies don't always survive, but they can be purchased, and we're seeing it with Virgin and stuff like that.
Yeah.
Let me have a look through here. Any way to get the ATO to give a casual employee for 11 months employment into the JobKeeper? Unfortunately, if they sit outside the rules that they've put down, you could try and plead the case, but no, ostensibly the way that it's written is the way that it is. There's one here from Sarah: paid parental leave for women is a huge concession. Also, I think the JobKeeper is great. What's your opinion in this seemingly excessive government spending? I'm not sure if I can quite see through that question, Sarah, but happy to have a chat with you another time. Craig's Kmart has great shirts for $6, Andy.
I love it, Craig. Mate, as long as it's stretchy. Hey, I've just discovered stretchy material. It's the best discovery of my life.
I know, right? Because I'll be out here soon. I've got a question. So this is from Craig, a real question. In regards to the JobKeeper, if an employee claims to be sick but doesn't have sick leave and refuses to come to work, where do you stand? Well, effectively, they're going to get the JobKeeper regardless, right? Because it's either going to be JobKeeper or job seeker. So that's now a performance management type of role that you've got to go into. I'm not going to give you legal advice, but standard business protocol, how Jason and I would probably run it in our businesses, is I'd be issuing written warnings.
Absolutely. Put it in writing straight away.
Written warnings, and then followed up by another written warning. Seek some legal advice from employee or whomever, or your solicitor, or HR specialist that you may or may not know. And yeah, because ultimately you can fire people and make them redundant. Like, COVID doesn't make your employees untouchable, but it still has to be proper course, right? And the difference is, if they're not working for you, then you don't pay superannuation, right? If they're working for you, you pay superannuation on the JobKeeper allowance.
Yeah.
Where's the wine that you're drinking? There it is. And I think that's an appropriate question to finish up on, mate. So thanks for joining in, everybody. Appreciate all the questions coming through. And we do have a virtual dinner to get to, but next week, let's talk about opportunities. I think we've sort of decoded a lot for people, and that doesn't mean if you have questions that we can decode or challenges that you're facing,
chuck them out there.
Through. Yeah. But I think the world could do with a bit of optimistic talk at the moment, so maybe that's what we'll do next week.
Yeah. All right, mate. Fabulous to hang with you again, mate, on a fantastic Friday, and good Paul could drop in. So thanks, mate, and have a great weekend, everybody.
Indeed. Enjoy. See you guys.
See you guys.